traders, Gavin McMaster here from Options Trading IQ, and today we're going to be talking about the risks of covered calls. Before we get started, just a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So covered calls are often hailed as the go-to strategy for conservative investors seeking steady income. But is it as safe as it seems? Well, today we'll uncover the hidden risks of covered calls and how to manage them. Firstly, the appeal of covered calls. So a covered call combines stock ownership with selling a call option. You collect a premium, generating income while holding the stock as collateral. It's often marketed as low risk, but there's more to the story. This strategy may seem simple, but beneath the surface, several risks could derail your returns. Here's a quick breakdown. When you sell a call, you agree to sell your stock at a specific price if the buyer exercises their option. You keep the premium up front, but your upside is capped and your downside risk remains. Let's explore the key risks of this strategy. Firstly, you have limited upside in a bull market. So in a rising market, covered calls will limit your gains. If the stock price exceeds the strike price, you have to sell at that level, missing out on any further upside. This opportunity cost can be frustrating, especially during unexpected rallies. For example, if you sell a $55 call and the stock soars to $70, you lose out on $15 per share in potential profits. The premium provides some cushion during a downside move, but it's rarely enough to offset significant stock declines. Covered calls don't eliminate the inherent risks of owning the stock. For instance, if you sell a 105 call for $3 and the stock drops from, say, 100 to 80, your net loss is still $17 per share. So rather than a $20 loss, you've got a $17 loss. As you can see, the premium isn't a shield against major losses. It will help against small drawdowns, but not major losses. We have early assignment risk, which is something that a lot of traders are concerned about. Early assignment can disrupt your plans, especially if the stock pays a dividend or the short call goes deep in the money. You might lose out on the dividends or face unexpected tax consequences. Imagine selling a $50 call only to have it exercised early before an ex-dividend date. You lose both the dividend and you lose the stock and any chance for further upside gains, and you've potentially triggered capital gains tax event. If you had a nice gain on that stock, you've held it for a long time, and that gets called away early before you were expecting it to, you could face a capital gains tax bill. Once you sell a call, your ability to manage the stock position is constrained. It's a little bit trickier to manage a covered call position than it is to manage just a single stock position. You can't sell the stock without first closing the call, which may cost you more if the option value has increased. The reduced flexibility, to me, yes, it's a risk, but it's not a massive factor, to be honest. As expiration nears, you need to actively manage your position. Whether the stock is above, below, or near the strike price, each scenario demands attention. For example, if your stock closes at 50.01 and you have a $50 strike price, you're going to face automatic assignment, and that could incur transaction costs. And again, you're going to be losing the stock that you have, potentially triggering capital gains tax. So you really need to manage the position as expiration approaches, particularly if you don't want to lose the stock. You might have to make sure you buy back that call option so that you don't get your shares called away, particularly if the stock or the strike price has gone in the money and there's very little time premium left. That's when assignment becomes more likely. So despite these risks, covered calls can still be effective with proper management. Here are some tips. Choose realistic strike prices. So if you're not keen on having your shares called away, you'll want to be looking at further out of the money strikes with a fairly low delta to reduce the chance of that call going in the money and your shares being called away. If you're selling at the money options, your premium is going to be the highest, but you've got a very high chance of these shares being called away. So choose your strike prices based on your preferred outcome. Look to sell calls in high volatility markets for better premiums. So as volatility rises or is high, the value of call options goes through the roof. You can generate a lot of premium for selling those call options, and that could be a great time when volatility is high. Again, just make sure you're choosing an appropriate strike price. Make sure to monitor your positions regularly and have a plan for early assignment and how you're going to manage the position, particularly if the strike goes in the money. So in conclusion, covered calls aren't without risk, but with the right approach, they can generate income while aligning with your goals. Always weigh up the pros and cons and stay disciplined. Thanks for watching. If you found the video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Reach out anytime with questions and have a great day.